Hey everybody, it's Elliott with Touchstone Financial Education. I'm the chief content creator here, coming you from Northern California where it has been extremely hot. I know there are storms across the country and power outages, so please everyone be safe and stay cool. Today, we are going to talk about the markets, a few stock picks and ETFs that I like, inflation, and of course, the Federal Reserve. But before I do, let me give you a little bit of an update here. We have updated our website, so please check it out. We've updated our list of classes for July and August. So if you're interested in learning about retirement and investing, please check us out. Shoot us an email. We'll respond within 24 hours. Also, we have updated our YouTube channel and LinkedIn as well. You guys can find me under Elliott C. Cox II. I really enjoy seeing the faces of all the listeners across the country and around the world. So please keep it up. Like I said, I do appreciate it. And also, if you guys have any interests or questions, send us an email. We'll go ahead and incorporate it into these podcasts as we've always done the last couple of years. So thank you to our longtime listeners and welcome to our new listeners. Now, on to what we're getting to today. Second half of the year and stock picks and the Feds and that all important inflation. But let's start it off this way. The first half of the year's performance was great. The S&P 500 index came in at 14.5%. The Dow Jones Industrial Average 3.8%, and of course that tech-heavy Nasdaq came in at 18.15%. So the first half was really good. Remember, the average rate of return out of the S&P 500 year after year after year, going back 4 or 5 decades, is no more than 8 to 10%, and we're already like almost double that. So great year. We're expecting the second half of this year to also go very well. And of course, the leadership here was technology, with the obvious being the boost from artificial intelligence. I'm hoping that the rally will continue to broaden, the bull market will continue to broaden. And yes, there'll be some down days along the way, but overall, things are looking up. And when I say looking up, let's take a look at some of the macro information, especially with what the Fed is looking at relative to lowering interest rates later this year. They've said this time and time again. They are, quote, following the data. Well, what does that mean? They are following unemployment, consumer spending, and of course that all important inflation. So on the unemployment front, unemployment has ticked up to 4.1%. It's still extremely low. So the economy is humming along at a really good clip, not seeing a recession on the horizon. Consumer spending, as high as interest rates are, people are still spending money. Even travel costs have come down a little bit and people are starting to travel more. So these are a couple of things. And then, of course, the inflation number, which we've gone from a little over 11% last year down to 3.5, which is good. Now, it sounds good on paper. Let me put it that way, because we are not feeling it at the grocery store, at the pump. No way, right? So they say inflation's coming down, and it is on paper. But again, I know you guys are feeling it when you're shopping for groceries and you're putting gas in the car. But as they lower rates this year and things begin to cool, hopefully we'll see some of these prices come down. And on the flip side of that, because this is important too, wages haven't kept up with inflation, but we will see hopefully some wage increases on the horizon to offset that increase in prices to give us consumers a little bit of breathing room in our monthly budget. So that's pretty much it for the Feds. Keep watching lower interest rates later this year. Now, on to stocks and ETFs that I'm watching and why. So, for the second half of the year, we're expecting technology to continue to lead this rally. That's not a secret whatsoever. Anybody who's watching the market knows that. All right. We're getting ready to go into earnings season starting tomorrow. So keep an eye on your favorite positions. This is for you stock pickers now. Keep an eye because things will continue to grow. Now, a few of these positions that I'm watching personally, and I've mentioned a few of them before, I'm watching Palantir, Supermicro Strategy, SM as in Mary, H, which is a chip ETF, and then of course TQQQ or T triple Q, which is a leveraged ETF. And I'm going to start with Palantir. I've talked about them before. They started the year with the rumor that they will be added to the S&P 500 later this year. They are heavily involved in artificial intelligence, and a software platform that kind of made them famous was they designed the software that helped to locate Osama bin Laden. So they get a lot of government contracts, and they've really done a good job moving into the commercial space. Things will continue to grow for them. And they've gone from about $21 a share up to about $28 a share where they are today. But if they get added to the S&P 500, watch out, it's off to the moon. For you beginning investors, what that means is if it gets added to the S&P 500, 500 of the most popular growth stocks out there, all of those index funds that you see in your 401k, or maybe you have them in your IRA or your brokerage account, they will have to add Palantir to the mix, which is going to put more upward pressure on the stock. So do some homework, check out the news on Palantir on your platform. Also check out news on places like Seeking Alpha, Bloomberg, Business Insider, and see what you can find out before you add it to your portfolio and or watch list. So it's really good. I'm expecting things to be great for Palantir long term. And then of course we have Super Micro Strategy. Now, the reason I wanted to record this today is because of Super Micro Strategy. They are going to be splitting their stock 10 for 1, and that trading post split will start on August 8th of this year. So, in a little less than a month, they're going to be trading at a 10 for 1 stock split, and they're trading 8.85 per share, something right now as I record this. So, watch out. They are up 210% year to date. And when stocks run like that, you think, well, maybe I missed the boat because it is a big artificial intelligence play, you probably didn't miss the boat. Now, will you get another 200% out of the position for the rest of the year? Maybe not, but it's still a great play, especially if that stock split works as it is working for Nvidia. I'll tell you, stock splits are back, guys. I remember when I first started doing this, stock splits were all the rage in the mid to late 90s, and it seems they are making a comeback for a lot of these tech companies. So keep an eye on that one. Again, do your homework as well. Use your platform, Bloomberg, Business Insider, Seeking Alpha, whatever else that you were using. So those are two of the stocks, and let's get on to those ETFs. SMH, which is a chip ETF. The reason why I like them is obvious. It's chock full of Taiwan Semiconductor and Nvidia and AMD and Qualcomm, etc. And chips will continue to do well as AI continues to remain at the forefront of this bull run. And because it's an ETF, this isn't something that you necessarily have to trade, but you can hold it long term or until one day, as all things turn, the chip sector begins to slow down. But hopefully by then, you've made some money and maybe it's time to move on. Now, last but not least here, I am watching TQQQ or T triple Q. And I'll tell you, it's a leveraged ETF. And if you don't know what that is, that means that if you take the NASDAQ 100, QQQ, and you look at its performance, like I said, it's up 18.1% year to date at the end of the second half of the year. That means that T triple Q doubled to almost tripled in its performance. So they use options to enhance performance. This means that it is super aggressive, it is super volatile, so this is for you aggressive investors only. If you're learning about investing at this time, add it to your watch list. It's a great way to get comfortable with a little more volatility, especially if you want to be a more aggressive player in the stock market. Now, I would say you can buy and hold this position, sure, but if tech turns down, this will turn down greater than the triple Qs. So, for example, if the tech market, let's say the triple Qs turn down 3%, this thing will be down between 5 and 6. Again, super volatile, not for everyone. It's aggressive. Add it to your watch list. For those of you who possess the intestinal fortitude, go for it. I like it in the theme of artificial intelligence, chips, software. And by the way, I'm going to add some cybersecurity today. I think that is going to continue to grow as well. As long as artificial intelligence is expanding, we need that security component. And that's where, again, circling back to Palantir, we could take a look at that as well. Remember, they made their bones by finding or helping to find Osama bin Laden from the use of their platform. So these are the kind of things I'm watching, guys. I'd like to talk about expanding into other sectors, but at this time, because there's so much going on in tech, we are on the cusp of earnings season. I'm going to leave it to tech today. Oh, no, I'm not. Excuse me. I'm going to add China to the mix. Sorry about that. China has been beaten up for the last few years because of their real estate issues, unemployment, and China is not very transparent about their macro information, meaning how quickly or slowly their economy grows, the employment numbers. But a few weeks ago, almost a month ago now, the Chinese government actually acknowledged there was a problem with real estate and they are working to fix it. Now, would I jump into Chinese stocks or ETFs today? No, but I am adding it to my watch list because there will be a turnaround here. You can't count China out. They're too important for the global economy. And for those of you who get in first, who possess that intestinal fortitude, I do believe you will be rewarded over time. So please take a look. Again, use your platform and those other sources I mentioned to start watching China because things will be turning around. And you can even kind of see it, for example, in some of their EV stocks like BYD. Very popular cars. There is a disconnect between some of that macro information and a few of their stocks, but that will broaden. So I'd like to see you guys take advantage. If you're a moderate to slightly conservative investor, continue to watch, but don't be the first one to jump in the pool. Okay, give it some time to get rid of its volatility, and maybe a slower, more moderate rate of growth is your speed. Then go for it. So it might be a little longer for you moderate to slightly conservative investors, but China is something to watch nonetheless. One of the last things I like to say today is that, and I stress this with all of my clients, especially my aggressive clients, when we're investing in these type of stocks and leveraged ETFs, etc., please use stop loss orders. Now, what's a stop loss order? It's an order that you place instead of just selling your stock or your ETF while the market is open. You click on market order and your cash is back in your account immediately. It doesn't work like that. The way the stop loss works is you get to set the sell price for your position. You get to leave that order open on the books for 1 day, a week. Most platforms will allow you to keep that order open for at least 3 months. And the reason we use the stop loss order is because just what the order sounds like. We are stopping a loss, or as I like to think of it in this case, with the bull run we've had in technology, you are protecting your profit. So let's say you bought a stock at 4, it is now trading at $9 a share and you're starting to think, well, maybe it's time to get out or to diversify. That's great. Instead of selling it right away, you can set, let's say, a stop loss order at $9.75 a share. So if it gets to 9.75, the order will be executed automatically. You don't have to think about it. There's no emotion involved, and the position is gone. So please consider using that stop loss to protect your profits. Now, if the order doesn't get executed and it is canceled because it just stayed on the books too long, you can always reset it. And what I like to see people do is, as stocks move higher, as we've seen in the last year and a half, especially in tech, always reset the stop loss order higher and higher. This gives us an opportunity to evaluate the position, see if it's still a good one for us, and again, protect those profits. So if we bought something at 4, we set a stop loss order at 6. Well, it moves through 6, it doesn't come back down, or say, yeah, basically moves above $6 a share. Then let's say we set the next stop loss at $8 a share. All right, well, it climbs through 8, doesn't get executed, so on and so forth. Guess what? You have been taking advantage of performance while protecting your profit. And I think that's very important in a bull market because we get complacent. We think it continues to go up, and that's a natural human response to what's happening, especially when you're making money. But the discipline of investing requires that you always are willing to take profits, especially with your aggressive positions. If you're a buy and hold investor, then this doesn't really apply to you. This is again for folks looking to play the super micros and the Palantirs and the T triple Qs, the ETFs, and a handful of other tech stocks that are going to the moon. And of course, when we take a look at China, same thing on their stocks and their ETFs. Well, guys, thank you once again for listening. I really appreciate all the feedback that I get. And we as a team here at Touchstone Financial Education work really hard to put these out. And I'll tell you, please let us know what you think. Shoot us an email, we'll respond. If you have any questions on the class list that we just posted on the website, let us know. We could even put together a special class for a group of you and your friends, colleagues, family, whatever, to discuss what's going on in the market, or even just to help you learn about how to invest, how to open an account, etc., whatever it may be. So thanks once again, and please like, follow, share, and subscribe. We are on LinkedIn, Facebook, YouTube, and a ton of other platforms I'm sure you guys are listening to from, like Apple and Spotify, etc. Thanks once again. I'll be talking to you soon. And by the way, I've got a joint podcast that's on the website with someone that I've been working with for a few years. And we just started a series of three. The first is on saving money, tracking expenses. Tomorrow we're recording on how to invest, or how she got started investing in the stock market. And the third one will be about real estate investing. So please look out for that as well. You'll find it again on the website at touchstonefinancialeducation.com. Everyone take care. Thanks for listening, and until next time.